In 1984, the world was chasing hot stocks and fast profits. But Warren Buffett, armed with clarity and conviction, wrote a letter that whispered a different truth. A truth that would make people like Charlie Munger, Bill Gates, and many others billionaires. If you're a retail investor confused by today's markets, this video will equip you with 5 timeless investing principles that the world's smartest money still follows today. Make sure to hit subscribe and the bell icon, because every week we decode Buffett's letters to sharpen your investing edge, so you don't chase noise, you build wealth. Buffett starts with a confession. He says Berkshire's performance in 1984 was mediocre, even though it gained $152 million that year. Why? Because as capital grows, small wins don't move the needle anymore. He writes, accomplishing this will require a few big ideas, small ones just won't do. It's the big ideas only filter. He doesn't chase dozens of average opportunities. He waits for a few great ones. Think about those who identified Nvidia in 2018 when the world doubted AI chips, or Apple in 2016 when analysts wrote it off after slowing iPhone sales. But spotting big ideas is just the start. What separates a great investor from a good one is what they do when others panic. Buffett drops one of the most underappreciated truths. When companies with outstanding businesses and comfortable financial positions find their shares selling far below intrinsic value, no action can benefit shareholders as surely as repurchases. He's not talking about buybacks for vanity or to boost EPS artificially. He's talking about intelligent buybacks, done when shares are cheap. Apple spent over $500 billion in buybacks over the last decade because they believed their stock was undervalued. Shareholders were rewarded handsomely. In contrast, Paytom's early talk of buybacks sparked controversy because the value didn't match the price. When done right, a company can buy $2 worth of value for just $1. But how do you know what a company is really worth? That brings us to Buffett's third and most critical rule. Buffett reminds us that book value and reported earnings are just rough proxies. What truly matters? The gain in per-share intrinsic business value is the economic measurement that really counts. Think of intrinsic value as the engine under the hood. The market may get distracted by the paint job, but eventually the engine wins. In 2017-2020, ITC was the butt of memes. Slow, boring, dead stock. But guess what? While traders laughed, the intrinsic business value kept rising. Cash flows, FMCG growth, hotel demerger. And in 2021, the market finally caught up. We look to business performance, not market performance. If we're right about the business, the market will follow. And yet, in a fast-paced world, the hardest thing isn't analysis. It's what you do while waiting for the market to catch up. Buffett calls it masterly inactivity. He admits that in 1984 there were barely any stocks that met his standards, and doing nothing was painful, but also smart. He quotes an English statesman, "Greatness was achieved through masterly inactivity." Think of investors who didn't chase Zomato, Nikar, or Paytom at IPO peaks. Instead, they stayed liquid, watched, and struck only when value emerged. Doing nothing when you have nothing to do is not laziness, it's discipline. But here's the final truth. Even if you do everything right, the market won't always reward you immediately. That's where your conviction will be tested. Buffett reflects on Geico in 1984. The stock didn't move, but the business was compounding beautifully. He wasn't worried. We would far rather have the business value increase by X while the market value decreases than the other way around. Look at Tata Elxsi. Between 2017 and 2020, it barely moved, but it kept building IP, expanding margins. Then boom, 3x in 18 months. Stock prices may zigzag, but value always travels in a straight line, up or down. You just have to be wise enough to know the direction and patient enough to let the world see it. So what does Warren Buffett's 1984 letter teach us? Bet big, but rarely. Reward companies that return value, not hype. Think like a business owner, not a speculator. Master the art of patience. And always remember, the market may be moody, but value is eternal. If you apply even 2 of these lessons, you won't just beat the index, you'll beat your own doubts. If this video helped you see investing differently, do yourself a favor, subscribe, and join our tribe of long-term thinkers. We break down one Buffett letter every week, because decades of wisdom shouldn't stay buried in 30-page reports. Like, share, and remember, your capital deserves conviction, not confusion.